The TV show Kaun Banega Crorepati was first telecast in the year 2000. With an entertaining quiz format and a well-spoken Amitabh Bachchan hosting it, KBC almost immediately rose in popularity and dominated the TRP charts. To put popularity numbers, over 3.1 crore audition entries were received in the year 2020. But if there is one thing that KBC has not churned out enough, it's the number of Crorepatis. In 12 seasons, we have seen a total of 18 Crorepatis from this quiz show, with 4 of them coming as recent as the last season. Hi everyone, my name is Shankar Nath, and in this video, we'll want to shift your attention from a reality TV show and help you become a Crorepati in real life. In doing so, we'll focus specifically on how one can use tax-saving financial products to become a multi-Crorepati before one retires. In true KBC style, we start with a question. Why does the government give tax benefits? Very simply, the government does that to encourage higher savings. And the more individuals save for their own retirement or medical expenditure or other essential expenses, the lower will be the government's expenditure bill for taking care of them. In other words, it is simply in the government's interest that every citizen of a country becomes a Crorepati. So now that we have our newly found utopian ambition, let's apply this Kaise Banunga Crorepati logic to a few tax-saving products and see if it really works. Let's start with PPF or Public Provident Fund and with some simple assumptions. Firstly, the maximum investment allowed under PPF is 1.5 lakhs per annum, so we'll stick with that. Secondly, the average Indian works for about 35 years, so we'll use that as well. And finally, let's assume that the average PPF interest rate for the next 35 years will be just 7% per annum. It was much higher a few years back and is currently at 7.1%, so let's settle for 7%. We feed this data into a simple projection table and figure that in 35 years, our PPF account would have a no-risk wealth corpus of 2.2 crores. In addition to this 2.2 crores, let's not forget that taxpayers in the 30% slab would have also saved up to 45,000 rupees in taxes every year. We'll discuss more about this taxes saved part later in this video. Okay, so PPF over 35 years can potentially generate a corpus of 2.2 crores. Now let's apply the same concept to ELSS or tax saving mutual funds. The underlying asset in ELSS funds are equities, which means the performance here will be more volatile as compared to PPF. In fact, here are the annual returns of PPF versus an average ELSS fund over the past 20 years. Do notice the relatively straight line performance of PPF and the roller coaster performance of ELSS funds, which might make comparison a tad difficult. However, when we examine the same data over a 5-year rolling period, it becomes rather clear that the ELSS funds offer a lot higher alpha. In fact, the table here shows that there have been only 3 occasions out of 16 when the 5-year annualized returns of ELSS were lower than that of PPF. We feel there is enough evidence here to support an assumption of 12% annual returns over the next 35 years. So we have 1.5 lakhs per year for 35 years at 12% annual returns that potentially gives us a moderate risk wealth corpus of 7.2 crores. 7.2 crores is quite a big incentive for everyone to allocate and dedicate 1.5 lakhs or 12,500 rupees every month towards one's retirement corpus from the very start of one's career. Now, we've used a monthly investment of 12,500 rupees, which might seem a bit on the higher side for some investors, especially in their 20s. Our suggestion is not to view this as a constraint, and one can start with smaller amounts of say 2,000 or 3,000 rupees a month and then up that number when there is more income coming your way. In fact, to help you out with the calculations, our team has put together a simple Excel sheet which will help you calculate your retirement corpus even if your monthly investment amounts are staggered. This Excel will be useful for all age groups and is available for download from the ETMONEY blog. I'll be sure to add a link of the blog post to the description of this video. In addition to ELSS and PPF, investments in the National Pension System or NPS allows for an additional 50,000 rupees of tax deduction. This means a total of 2 lakh rupees can be allocated to NPS, on which one can get up to 60,000 rupees in tax benefits. Now, we have talked extensively about NPS on the ETMONEY YouTube channel, and I've even examined the performance of NPS funds over the years. NPS funds have performed reasonably well, with most funds delivering about 10% annual returns across multiple asset classes over a 5 and 10-year period. Hence, it probably makes sense to assume a 10% annual return in our projections as well. So, 2 lakhs per year over 35 years at 10% comes to a corpus of 6 crores from NPS. So, to sum it up, that's potentially 6 crores from NPS, 2.2 crores from PPF, and 7.2 crores from ELSS funds. The idea here is not to compare financial projections of different tax-saving instruments, but more so to build an understanding that a large part of your accumulated wealth, or maybe the whole of it, can be fulfilled by disciplined investing in simple tax-saving instruments. The more we think of it, the more it sounds convincing that the tried, tested, and uneventful products like PPF, EPF, NPS, and ELSS funds can do a lot more in terms of wealth creation than other exotic sounding products. In addition to wealth creation, the use of tax-saving financial products carries a bonus in the form of money saved from taxes. For people in the 30% tax slab, there is potentially an annual savings of 45,000 to 60,000 rupees. An excellent way to use these savings is to reprocess them in a health insurance and a term insurance plan for yourself and your family. And with both these insurance products offering tax deductions on the premium paid, you can reprocess the tax saved from a tax-saving investment product and continue to save taxes in a tax-saving insurance product. If you need more information on these insurance products or would like to buy one, do visit the ETMoney app or the ETMoney website, where you can compare multiple plans from different insurance companies and purchase these plans online. Our point is simple. One of the easiest ways to be financially free is to invest in uncomplicated tax-saving instruments and in a disciplined manner. And there are enough reasons to support this view. First, there are the tax benefits at the time of investing, which is sort of a 30% discount that the government is giving us in the form of Section 80C and 80D deductions. Secondly, most of the tax-saving products have tax advantages during maturity as well. So products like PPF, EPF, and NPS don't attract capital gains on the maturity amount. Thirdly, the performance of these investments have been quite admirable to the point that they often rank in the top performance quartile when compared to their peers. For example, EPF, PPF, and the NPS debt funds are worthy competitors to most debt mutual funds. Likewise, ELSS funds often top the equity mutual fund performance charts. So to sum this up, the very fact that a retirement can be planned around these investments, plus one can maximize taxes in the process and then use those tax savings to buy insurance, is surely a formidable investing story and something that all investors should certainly consider. And with this, we come to the end of this video. I hope you liked our content and will draw many learnings from the information and insights presented. Don't forget to subscribe, like, comment, and share this video with your friends and colleagues. Thank you for watching, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.